Hey folks, this is Jeff Ervick from Valoris Capital Partners. Wanted to come to you today with a special guest. I'm starting to have a few different let's call it webinar educational services, right? That I want to be able to have host a few really good high quality folks on here that have been instrumental in my journey in passive investments, and I feel like you guys could definitely benefit from as well too. So. Without further ado, I wanted to introduce a buddy of mine. His name is Paul Herbis from Equity Institutional Services. He's an account executive that is really fundamental to when I started investing in my self-directed IRA with equity into real estate. And so I wanted to introduce it because it's a lot of people don't get this or don't understand that you can use your old 401k, which is now an IRA, to invest into real estate, creating passive income for your retirement, and not be locked into the stock market and all the market swings and so forth. So, we're going to have a really great discussion today on what that is like and what you can use it for and all the steps and all the intricacies that go involved in that. So, without further ado, Paul, welcome to the first episode of our show. How you doing, buddy?
Jeff, doing great. Thank you so much for having me on. Really appreciate it and really appreciate the insight that Valoris Capital has and how paramount premium is placed on investor education. I mean, it's so important in our day and age with due diligence and just ensuring we can help those investors on their investment journey. And it's certainly something I'm passionate about is going ahead and ensuring they can get into their investment in a tax deferred or tax free position. So yeah, I wanted to take a moment. Thank you for having me on here today.
Excellent.
Really excited to go ahead and demystify the
Ah,
whole IRA industry.
I appreciate it. Yeah, no, there's a lot of questions people have, and it's funny is I talk to so many people that have no idea that they can do this, right? And they're like, oh, well, I might not
Mm,
have enough capital to do it. I'm like, well, do you have an old 401k? Like, yeah, I've got a lot of money sitting in that. It's just sitting in one of the big banks or whatever it is. I'm like, well, then let's have a conversation, right? So. But before we
exactly.
get into it, I'd love to have a chance, maybe if you want to explain or like give a little background of yourself, right? Where you
Yeah.
came, how you got into this business, and that way we can start there and just give a little bit of intro.
No, would absolutely love to, Jeff. Really appreciate the opportunity once again. And yeah, excited to demystify and really speak about tools that the wealthy have been using since the 70s, right? I mean, so many savvy investors have taken advantage of this, but so many investors don't even know it's an option, right? And yeah, would love to speak about myself and what led up until here. So, been involved in a few different careers and career journeys throughout life. Once was a collegiate football coach, bounced around in construction with real estate, learning more about that, and then made my way to IT sales. So have been in quite a few different arenas, but a big part of what brought me here to Equity Institutional Services was actually Midland Trust. Midland Trust Company was actually acquired by Equity back into 2023, and it's been a wonderful thing. I mean, we've gotten the backing of now the largest custodian that currently houses $70 billion assets under custody, and who's been doing this now for 51 years. So it's just been an absolute great thing to be a part of. And I mean, there are a few different pillars into how I ended up here, how we were acquired. Formerly back in our Midland days, we were recognized by Forbes Advisor as being the best custodian to work for when it comes to those private equity investments. Now, a lot of those are going to be syndication based. So yes, this is just a wonderful opportunity, and yeah, happy to be here today with you, Jeff.
Awesome. Yeah, no, it's great. So I didn't even know you were a collegiate football star and a coach in the past life. So that's awesome, man. So and glad to see your guys are doing great. And as I mentioned, I'm a customer for you guys, right? So
Right.
so I can talk experience, right, when it comes down to the reputation that Equity Trust and Midland Trust have is by far the best in the business, and I love it. So I refer people to you guys all the time. So
No, it's great.
yeah, so let's get into it. So if you don't mind, maybe giving us a little background on what is a self-directed IRA, right, and how it differs from like a traditional IRA. Yeah.
Yeah, great question, Jeff. So that self-directed portion is really just one big fancy marketing title. I mean, that's really what it is. It's an IRA like any other. So whether it's a traditional IRA, Roth IRA, simple SEP, what have you, it's an IRA. Now, what's really going to change things is who's going to be the custodian, who's going to be holding those assets, and do they work in the private sector? Now, a lot of these large custodians, I mean, they're probably at the back of your head. They perform at halftime Super Bowl commercials, right? The Schwabs, the Fidelities, the JP Morgans, what have you. They're concerned with assets under management. It's really their business model. It's really what gets them going is having people placed into different mutual funds they offer. It's their cup of tea and it's what they built their business on. Where we came out 51 years ago is a completely different position. And that's how can we go ahead and get people into what they want to invest into what they're excited about, whether it's a hard asset like real estate or even an equities investment like a syndication. How can we go ahead and unlock that door? And how can we really get people to take their financial journey into their own hands? And that's really where this industry came about, is going ahead, asking those hard questions and ensuring we can get people in the driver's seat of their own financial journey, right? I mean, at the end of the day, it's really what custodian are you using to go ahead and do it? Those other custodians, it's not administratively feasible for them. They don't want you to go ahead and self-direct your funds because it's a burden, and they're not able to go ahead and get their performance fee on those assets under management. Where our position as a custodian is, how do we empower individuals? How do we get them into those holdings that they care about? And how can we do it in a very seamless process where there's not a lot of friction? So that really is going to be the self-directed IRA industry in a nutshell. Is it was created for individuals who are looking for ways to beat the public equities market. I mean, to get more favorable returns into assets they actually believe in, rather than just have an old high school buddy or or old college dorm roommate go ahead and place funds. I mean, Jeff, I've
Yeah.
heard horror stories of individuals who were invested into different funds and they had no idea. I mean, there's so many different forgotten 401ks out there that people will just let sit after a job change. I mean, there's one client I was speaking to, for instance, who was invested in an international real estate fund. He liked real estate. And I asked him, I said, where is that placed into? He had no idea. So I told him to go ahead and ask his advisor, what countries is it in? Couldn't tell him, right? So, I mean, at the end of the day, this is a great way to know where your money's being placed, what assets it's held into, and who's actually steering the ship, right? And it's just a wonderful way I've seen change many different financial trajectories for many different individuals.
Yeah. No, it makes sense. I mean, it's right there in the title, right? Self-directed, right? It's not market directed, right? It's self-directed. So having a chance to know that you're in control, or at least investing in opportunities that are in control for your future, is key. Now, you mentioned quickly a few different of the assets that are allowed to be invested in, and I see on the screen there it says a few more. Like, give us a little background of what type of assets are able to be invested in and what is not able to be invested in
Mhm.
for the self-directed IRA.
Great question. Great question, Jeff. So there's so many different assets that are on the table. I mean, when I go ahead and I look at the portfolio of holdings that our clients will go ahead and invest into, it's very expansive. I mean, it's real estate property, it's real estate syndications, it's lending, right? So it's those private credit and private debt funds as well that these IRAs are investing into, and those are phenomenal because you're avoiding this thing called UBIT, right? You're avoiding unrelated debt financed income. So they're wonderful vehicles when it comes to self-directed IRA investments, but a plethora of others. I mean, you could go ahead, play the bank, loan out your own funds from your IRA, even go ahead and invest into private equities, private placements, series funding. I mean, so many futures, foreign exchange trading, so many different arenas that are able to be unlocked. Now, when it comes to what you can invest into, there are a few asset classes as well. One's going to be collectibles, right? So that beautiful red cherry Ford Mustang that I I have my eye on, I'm not able to acquire, right? Because
Yep.
it's 60 years old and no one's able to put a price tag on it, right? The beauty's in the eye of the beholder. So the IRS doesn't actually have an amount when it comes to making those distributions. And there's a few other things such as S corporation stock that already have that favorable tax position, and then life insurance that you're not able to actually pull the trigger on, but so many things that you can.
Gotcha. Yeah, no, I love it. And you mentioned something earlier too about being investing in private credit to not have to deal with UBIT. Can you kind of
Right.
go into a little more detail on that real quick? So obviously,
Yeah.
Valoris, we have our own private credit fund, right? So I'm loving this topic that you're bringing up here. But what's the difference between
Yeah. Great question.
investing in debt, right, or investing in lending, right, out of your
Yeah.
401k versus or out of your IRA versus
Yeah.
into something that might have that unrelated business income tax?
Yeah, great question, Jeff. So a big part of UBIT is UDFI. And what UBIT is it's unrelated business income tax. It's a way the government will try to go ahead and get another piece of the pie as they typically like to do. Now, a part of that is unrelated debt financed income, also referred to as UDFI. Now, this is going to apply to those investments that are made into real estate that's leveraged. And going ahead and using a cookie cutter example, right? I mean, say someone is investing $100,000 into an offering. And let's say, for instance, here, 50% of that offering's leveraged, right? Say 50% of it is going to be acquired by some financing of debt. Well, ultimately, at the end of the day, half of your earnings, half of your takeaways, half of that return on investment is going to be subject to that UDFI, right? So important to be aware of when making those investments into a leverage deal. Now, when you're investing into something like a private credit fund, you're the one actually going ahead and borrowing out those funds. You're not the one actually receiving the funds. You're actually the one going out and placing them into the market, so that UDFI isn't going to be subject to it because you're not investing into something that's leveraged. Rather, you're going ahead and lending those out yourself.
Gotcha. Yeah, that's awesome. That's a great explanation, and I think some people might forget about that sometimes because we have people who invest a lot of times into our syndicated asset class deals like a multifamily deal, and then we have people who invest into our private credit fund, right? So it gives a good opportunity for both. So would you be able to walk us through, right, the process of opening one of these, or what would be next on your agenda that you want to
Yeah,
discuss here? Yeah, maybe
no,
maybe
let's
we'll go that route versus me trying to have you jump around.
Jeff,
Right.
all good, all good. I'm a flexible guy. I can do backflips. I'm a bigger dude, but don't worry, I'm agile and pliable. So
Right.
we could certainly speak to the process, Jeff. So really, what that involves is going ahead and creating that vehicle. So creating that self-directed IRA, creating a place for funds to go ahead and be invested. I mean, that's really going to be 1A. Is let's go ahead and get it set up. Now, it's going to differ depending on how you're funding that account, right? Is it from a former 401k? If so, then we're going to go ahead and do what's known as a rollover. So funds would actually be pushed to us after we have that account open. I would help that high net worth individual investor to go ahead and send them rollover instructions to get their current custodian as well as that account number here of their self-directed IRA. Their current custodian would push funds to us. After we receive them, we typically go ahead and it would actually be a check that they'll send us in the mail. We'll
Yeah.
sit on it for 5 days until it clears. And then in 24 to 48 hours, we get them placed into the offering. Now, say they're moving IRA to IRA, also referred to as a trustee to trustee transfer. We'll have them endorse a transfer form, typically grab an account statement from them if their current custodian requires a medallion signature, and we'll actually pull funds at that point. So the investor will just need to ensure funds are liquid. That way they're ready to be tapped into. We'll pull them over into our account, much quicker process because it's all done electronically, wire to wire. Typically looking at a week and a half turnaround at that point, and then we'll actually go ahead and get them placed as well. So after we receive funds, we'll go ahead get that verbal authorization from the client, get them wired out.
Gotcha. So you're saying it might be from like starting a new account if someone was brand new, right? Starting a new account to getting it to where they're able to wire for an investment is probably how long? Like 3 weeks or so, maybe? Or
3 weeks if we're moving from a 401k. I've seen groups as quick as a week and a half to 2 weeks if they're
yeah.
doing that IRA to IRA.
Usually, I would say it's probably usually the latter, right? Or I would always err on the
A
side of caution,
100%, a
right?
hundred percent.
Because it's your I guess the person that would be contingent on that other custodian
You got
to
it.
liquidate it, put into a check, mail it out to you. Now, do most of them mail a check to you guys, or do they why wouldn't they wires? There's no wires back and forth, or
Yeah, great question. So a lot of it is just a security feature when it comes to that 401k rollover
yeah,
is going to be going ahead and actually issuing that check. Now we accept wires, so if that financial institution is so inclined to send, we're more than happy to go ahead and accept a wire transfer. Helps expedite timelines. But as you mentioned, Jeff, let's err on the side of caution when it comes to those timelines. And always better to go ahead and get started early. I mean, if this is something you're seriously considering, a lot of those custodians love dragging their feet when it
yeah,
comes to go ahead and getting funds out of their system. A lot of that plays into the fact that many of them are invested into CDs,
Mm,
right? So at times, some of these custodians find themselves in a little bit of a, a jam, sometimes being a little too illiquid. So yes, you're exactly right, Jeff. Let's get
interesting.
this started sooner than later.
Yeah, interesting. Yeah, that's good to know. Plus, I'm sure they're like, well, they're going to delay as much to get the
Yeah,
their assets under management. They want to keep that in there as much as possible, right?
you
All
got it,
right,
Jeff.
good. So next question. And again, I know we might be skipping around on your slide deck here, but this is good to see all this information as well too. But what role would you as a custodian play in managing a self-directed IRA? And then
Mhm.
how active or passive do you think the involvement is for the investment process, right?
Great question. So ultimately, when it comes to an IRA, you need a custodian. No, no ifs, ands, or buts. It's
Mhm.
an IRS requirement. So you're going to go ahead and need to work with somebody who can legally custody those assets. Now, when going ahead and making the investment, Jeff, it's actually going to be the IRA making the investment, not the individual. So that's important to know as well. So when I'm actually going ahead making that investment out of the IRA, let's use myself for example. That subscriber would be Equity Trust Company as custodian for benefit of Paul Herbis, account number 12345. And a big reason that's important is when it comes to go ahead and rectify, right? So let's say I own real estate property. Let's say I own a single family home inside of my IRA and taxes are coming up, right? I have some property taxes I need to foot the bill on. I wouldn't be able to personally pay for those. They would need to come from the IRA because the IRA owns it. So it's important when going ahead and undergoing these IRA investments to know who's the one actually making the investment. It's going to
Sure.
be that IRA at the end of the day. Now, same applies to cash flows, Jeff. So say I were to go ahead and invest into a private credit fund, for instance, with my IRA, those returns coming back to me, I wouldn't be able to personally accept them because it was made with IRA funds. Those funds actually need to flow back into the IRA account to then where I could take a distribution from them personally. Just an important order of operations when it comes to investing with that self-directed IRA.
Gotcha. Yeah, that makes sense. I mean, so the paperwork, right, needs to be signed. If there's, let's say they're investing into a subscription document or a PPM. So the paperwork would have to be filled out and signed by, or I guess filled out in name of the custodian or name of the account that's held by the custodian, not like John Smith or Jeff Urbic can't be the person on there because that's even though I'm owning my IRA, I don't technically manage it, right?
You got it.
Yeah.
That's
All
exactly
right.
right.
And then all the returns go back and get distributed back to the custodian's account, which is then where mine is held, right?
That's how you're able to take the biggest benefit, which is no capital gains taxes on those returns. I mean,
Yeah.
that's exactly how you're able to play the game. I mean, that's how you're able to defer those capital gains taxes on those returns, see them back in hand, and really create that compounding interest, either in the complete absence of taxation, like in a Roth account, or even in
Yep.
a tax deferred arena, like with the traditional IRA.
Okay. Awesome. Awesome. Now I know we're maybe we'll get into, well, I'll save that other question about the difference between Roth and traditional and how to offset that in the future. So is there anything that is you mentioned earlier that like I can't buy a car, right?
Mm.
With it like a vehicle that what other prohibited transactions are
Mm.
in there or what else like can you not in how can you not direct it to like something that you're going to go buy, I don't know, my own house or something like that, right?
Great question. Great question. And this comes up a lot with checkbook IRAs. So I just want to give you a visual for checkbook IRAs. What is a checkbook IRA? It's a manager managed LLC. So it's an LLC that is owned by an IRA outright. I mean, that's really what it is. It's single member, and it's an entity that provides limited liability protection and then ease of transaction. Now, that ease of transaction is sometimes where people find themselves in a jam when it comes to making these investments because they're able to make them at a touch of their fingertips, right, from a checking account. So it's important, Jeff, as you mentioned, what are the pitfalls, right? I mean,
Yeah.
what are those areas that you really want to avoid when you're going ahead and doing something new for the first time? That being self-directed IRA investing. And the first one I want to speak to is disqualified persons, right? So there's no self-dealing. Now, say I have real estate. I have a couple acres. I want to go ahead and purchase it with my IRA from myself. I'm not able to, right? That would be construed as self-dealing. Wouldn't be able to go ahead and get that accomplished. Now, what other parties am I not able to purchase directly from? my spouse. So I'm not able to purchase from my wife. My ancestors, so my parents and my grandparents, I'm not able to go ahead and purchase from them, nor any of my direct descendants. So my children, their marriages, so my son and daughter-in-laws, and then any of their offspring. So grandkids, great grandkids, their fourth, I'm not able to go ahead and actually invest or purchase from with my IRA.
Mm.
Now, who's on the table when it comes to family members? Um, Cousins, uncles, aunts, brothers, and sisters. The IRS doesn't think they're
Yeah.
going to do you any favors, right? I
Yeah, it's
mean,
true. Yeah, so if I lend my aunt some money, that's we're hoping she pays us back, but it's not going to be like something weird. Yeah. Okay.
you got it. You
Gotcha.
got it. Yeah.
Awesome.
And then
Yeah.
other things to be aware of, Jeff, like no commingling of funds, right? So say I did want to pursue with the checkbook, say I did want to go ahead, create that single member LLC so that I can go ahead and have access to those retirement funds, invest them as I see fit. Really important not to commingle, not to go ahead and mix my personal funds with those retirement funds because that checking account is retirement funds. So really important when I'm going ahead and making those investments, not to personally use it, right? Not to go ahead and use that retirement account to fill up my truck at the gas station when I'm going ahead and traveling cross country, right? Just
Yeah.
important to be using it for the right reasons.
Gotcha. Yeah, that makes complete sense. Now, what's the difference between a checkbook IRA and a regular, like a traditional self-directed IRA?
Great question. It's really going to be this middle layer in the screen here. I mean, it's really going to be that standalone entity within this process. And why people really consider this, Jeff, is for the limited liability protection. I mean, first and foremost, that's going to be one of the biggest benefits to going ahead and having a checkbook IRA. I typically see it mostly used for property purchases. So for people looking to go ahead, maybe do an Airbnb, maybe looking to go ahead, do a long-term, short-term lease, right? For in case anything unfortuitous were to happen, say somebody slips in the shower or falls down the staircase, what have you, just going ahead creating that additional layer of separation in case anything unforeseen were to occur. Now, really what it is it's just going to be a single member LLC that's manager managed. And this is something we could certainly go ahead and help with from a lift. I mean, we could go ahead, help with your articles of organization, the operating agreement, registering with the EIN, initially filing with the state, and even creating that bank account. I mean, all things that we have experience in doing. But another reason people like this, Jeff, is the ease of transaction. I mean, with something like this, you're able to have direct control of your funds. You don't even need to call up a custodian when you want to go ahead and make an investment. You don't need to call in for that verbal authorization. You're able to wire funds directly from your bank account as you see fit. So it's a lot more for the hands-on investor, right? I
Yeah.
mean, for somebody who really wants to dial it up a notch when it comes to their self-directed journey, this is something to certainly explore.
So, for example, like someone who might be like a flipper, right? If they have a flipping business, right, and they want to utilize their funds for that flipping business instead of sending it to their cousin, right, and their cousin B is the manager of flipping it, but they want to be the direct flipper, right?
Yep.
Their LLC would then go, for example, buy a property at foreclosure, right, or
Yep.
buy a property on auction.
You got it.
And then are there any limitations with what that person can and cannot do as a
Great
manager of
question.
their checkbook IRA and the property itself?
Great question. So you hit it right in the head, a sheriff's auction, right? A foreclosure. Having the power to actually charge a debit card or write a check on site is so powerful when it comes to some of these real estate transactions. Now, it's just important to be aware of no commingling. So, say you want to go ahead and take a distribution, say, "Hey, I'm doing really well. I'm generating some money with this real estate activity. I'm creating some wealth, and now I want to go ahead and pull some out and personally use it, right? Maybe I have a mortgage I want to pay down on my personal property. I want to own it free and clear. I want to take a distribution." Really important at the end of the day that when you're going ahead and doing that, you still need to involve a custodian for contributions and distributions. So say
Hmm.
I want funds in my personal account, you're not able to go ahead and take them right from that LLC account into your personal account. You're going to want to go ahead, actually send funds back to us as the custodian, and then take that distribution from us. Why? Because the IRS requires it. That's
Sure.
exactly
Yeah.
why.
Yeah, that makes
You need to report in for that distribution. You need to go ahead and include the IRS into that decision making. And the same is when I'm looking to contribute. So say I'm looking to go ahead, continue to put funds into my retirement account. I wouldn't want to go ahead and put my personal cash right into LLC account that holds my retirement funds, I would want to go ahead, contribute with the custodian, and then have the custodian send funds from my IRA into that LLC to where I could then invest it. Just another step, but an important one nonetheless.
Yeah, no, that makes sense. So, what about the folks who don't want to be so active in like the checkbook IRA type of investments? What if they want to invest in like a private credit fund and they want to invest with a sponsor, and
Yeah.
then that sponsor is the one who is doing all the management and doing the work of it? They just want to kind of sit back, let their IRA grow tax free, and then reinvest, compound it, and reinvest that into something else in the future. So that way, every 4 or 5 years, like their investments double. And if they're working with the right sponsor, what's the, or let's talk about that kind of IRA right now too.
Yeah, that's your typical self-directed IRA. And I mean that would be if someone were to anecdotally ask me what should I do? I mean that's where I would point them. I would point them directly into the self-directed IRA. You don't need the limited liability protection. It's not real estate property. You're investing into a fund. So with that, you're going to want the self-directed IRA without that LLC component. That LLC component would just be an additional layer that you wouldn't need at the end of the
Sure.
day.
Yeah.
So to go ahead and do that, you would just send funds to us as an institution after you have the account open, and then direct us to send funds into that investment. It eliminates one step of the process that you don't need in that journey, and frankly, you'll save on additional fees on the way because you're not going ahead creating that LLC, the operating agreement, the articles of organization. You're not doing that whole lift, and it's going to be much more straightforward for your investment journey.
Yeah, that makes complete sense, right? So if you're going to be buying your own rental properties,
Correct.
flipping them, and then I assume you can work the process like a burst strategy where you can buy them, you could flip it and sell it, all that money or profit comes back to your IRA, or you could refinance, right, out of that IRA, or is that possible? Is that
Ooh,
possible?
great question. So
Yeah.
this is a great topic, Jeff, and I'm happy you brought it up. So when it comes to an IRA, you're not able to use personal credit on behalf of your IRA, which is something really important to be known to. So I'm proud of my credit score. I think it's pretty fantastic, but I'm not
Yep.
able to go ahead and marry that to my IRA. When it comes to actually going ahead and incurring debt with an IRA on a personal basis, right? Now we're not talking about a debt fund. We're talking
Yep.
about refinancing, right? For like a property, you would have to get something known as a non-recourse loan.
Sure.
So you're not able to make that personal guarantee. And ultimately, at the end of the day, it's going to have a higher down payment. Typically 30% is what I see on the minimum end. And then it needs to be a cash flowing property. That
Yeah.
the originator is not going to be the one to go ahead and originate it if they're not going to see that producing income activity. Now, this is something that you would want to work with a third party on. We're not a loan provider
Sure.
ourselves,
Yep. That makes
but
sense.
I have seen savvy real estate investors use it to their advantage. Now, another area that I see a checkbook IRA used is foreign real estate. So if someone wanted to go ahead and purchase real estate, for example, down in Mexico, where maybe they're not going to recognize an IRA, right? But they will recognize an LLC writing them a check with cold hard cash. So that's going to be another instance of when a checkbook would be used.
Okay. Yeah, that makes sense. All right, so going back to self-directed IRAs, right? The normal ones, not the let's keep it to that part of the side so we can really talk about
Yeah,
how people who have changed jobs recently, because one of the things that we're putting out is a lot of different
right.
newsletters and stories and examples, even on my LinkedIn about again, I'm in tech sales, right? So that is the industry, right? Technology sales, right? And we see people that move careers every maybe 3 to 5 years, right? And so if that person
Mhm.
has spanned a 25-year career, they've potentially moved close to 5 times, right? Maybe into different jobs, right? So every time they leave a job, they have an IRA. Now, I'm not sure if they're combining those into a regular IRA, but that's the kind of person that I think would be very beneficial, right? To be able to take some of that. Maybe they split it in half. They keep some of it in the market and they take another one and put it into self-directed. And that way it gives them some diversification, right? So that's really what I'm interested in is
Yeah.
how do we teach and train, or how do we teach and explain to people that there's other options out there and this is why, right? These are the popular
Mhm.
reasons why. So you pulled it up. You were kind of speaking my language here.
Oh, Jeff,
So, yeah.
you're I you're speaking to the choir here. I mean, I once was a sales manager of a managed service provider in the tech industry, and
Yep.
I see this with myself, right? So I'll use myself as a case study. I go ahead, I changed employers, right? I was with this entity for a few years, and quickly after changing, I was able to access those retirement funds. So
Mhm.
once when you separate from your employer, you're able to actually go ahead and use those funds and invest as you see fit. Now, most people don't know it, and it's a sad thing, but most people neglect those old 401ks. They typically have 3 to 5 different 401ks just sitting at a bunch of different entities that aren't being managed appropriately. I mean, they're not checking up on them. They have no idea what they're actually invested into.
Yeah.
Some are just sitting in a money market fund, which are generating very low interest rates as compared to actually having those dollars work to them in an investment. So the most common way we see self-directed IRA started, Jeff, are former 401ks. That's
Gotcha.
really when you're able to go ahead, roll those funds over into something like a self-directed IRA where you could really get your money working for you in a savvy way. Now, I always get the question, Paul, what about with my active employer 401k? I want to use the former funds, yeah, but I also want to use these active funds too. Let's go ahead and unlock those. Now, it's a question worth asking. Most active 401k funds are off the table, but around 33% of them can actually be tapped into, and that's actually known as an in-service rollover.
Okay.
Now, they'll need to check with their current plan administrator to see if it's an option. But the worst case scenario is they're told no, they're exactly in the same boat they're in. The best case scenario, they get told yes, and they're actually able to go ahead and use those funds, take them out of the public equities market and into some private investments where they could see higher annual returns.
Okay, awesome. Yeah, I see a lot of people use this for, like you mentioned, diversification, getting into multiple different asset classes
Mm.
outside of just your mutual funds or market driven, right?
Right.
So, like real estate, job, like I said, job changes is a great reason to do it. And they are, they're illiquid, right? So, unfortunately, people can't say like, hey, I'm going to go use this to this cash flow I'm going to make from this to go, buy a car or pay for college or something like that, right? It has to be stuck in that IRA until you're at times where you can take a distribution, right? So traditional means after 65, you start taking some distributions or a Roth, you can actually keep it in there and let that thing grow for the rest of your life and pass it on to your kids, I guess, right? Too.
Well, that's it. Inherited IRAs are another subject too. So even when you're continuing to put that money away, I mean, somebody else is going to benefit from it one day, and that being your heirs, right?
Yeah.
So it is a great way to continue. I mean, I'll work with plenty of investors who are liquid. They have money in their checkings and savings, and they're very well off, but they prefer to invest specifically into a lot of these real estate deals with those tax advantage dollars because they want to create the generational wealth for that next generation, even long after they're gone through those inherited IRAs. Other reasons I'll commonly see people, as you mentioned, diversification, right? I mean, getting out of some of those liquid assets and into the liquid because they're sick of the volatile market. I mean,
Yeah.
if you even look into this past quarter, I mean, just with so many different things going on in our world, right? I mean, on a global scale, are we are we putting tariffs on? Or are we not putting tariffs on? Right? What's actually going to occur? You'll see that it'll be a much less volatile asset. That being real estate specifically. When going ahead and making those investments, you can go ahead and plan appropriately with it and not ride the wave of the market and really start to diversify your portfolio. Most people have all of those eggs in one basket. So once when a global catastrophe happens, they're affected just like many others, where instead I'll see those savvy investors start taking those eggs out of the public equities market and have both, right? Be well hedged, be diversified. Um, just another great reason to go ahead and explore opportunities like real estate with a self-directed IRA.
No, I love that. I love it. All right, so let's talk about the person who has already gone through the process, set up the account.
Yep.
They're ready to actively deploy some money, right? Is there a team or does Institutional Services provide a way for you to help them with due diligence when it comes down to choosing what kind of investment, or if they've already got an idea they want to go into real estate, can you guys help them understand that investment more? Or what is your role when that person gets to the point where they want to invest? And then that's part one. And then part two is when they're ready to invest, what do they do?
That's a great question. So at the end of the day, Jeff, we're not able to endorse investments. So I do want to speak to that, right? We're not a fiduciary. We don't give tax and legal advice. Our thing is being the custodian, right? Ensuring we can help you get from point A to point B in a frictionless process. And the way we do that is through integration and through different software tools. So we're actually able to get those private placement memorandums, those subscription agreements endorsed on the front end with IRA account opening. So it's one less thing that that individual high net worth investor has to worry about throughout the segment of going ahead and opening up that account and getting funded. Ultimately, after we receive funds from their current custodian, since they already have those subdocs endorsed up front, all they'll have to do is give us a call. And of course, we do that for security reasons. I mean, we're talking about people's retirement funds, people's livelihoods. We want to make sure that it is secure. So we'll
Sure.
go ahead, get a verbal authorization from them, and then deploy that capital. Now, when it comes to equity institutional services, we differ from a lot of custodians in our approach when it comes to client service. I mean, most custodians in the industry have a phone tree. Press one if, press two if, press three if. It's crazy. People are sick of that, right? I
Yeah.
mean, people want to have a personal relationship with someone, and that's how we set ourselves apart in another lens, is going ahead, having an IRA dedicated rep for that individual investor so that when they do have a question, whether it's a required minimum distribution later in life, right? Or whether it's a question on their contribution limit for a certain year, we're ready to help. We're ready to help bridge that gap and make that investment journey that much easier.
Okay, awesome. And then so you mentioned that there's like you don't help them do the due diligence in the deal, but once they're ready to make that investment, what would be the process for them to like start signing the documents and go for? Is there a way you can show us how that works?
Yeah, so a lot of that is actually going to be done through a one-path integration. So we actually have a way where these investors can actually complete that when they're going ahead and opening up their account. Just another way that we really help differentiate ourselves is going ahead and actually helping out on the front end. We want to make it easier for these limited partner investors, especially for those who are doing this for the very first time. So ultimately, when they're going ahead and actually filling out our online IRA application, they're actually able to go ahead and endorse that subscription agreement online through DocuSign as well. We're in the 21st century. Let's go ahead and leverage technology. Let's make it easier to
Yep.
go ahead and deploy capital, because at the end of the day, it should be as easy to go ahead and invest with your retirement funds as it is your personal funds. There's just an additional layer of actually creating that account and then completing those documents when creating the account. So we don't want to make people have to go back and forth a bunch of different times to create their end journey. We want to help get this buttoned up on the front end as much as we can.
Nice. That's awesome. Excellent. And I think we have a little treat. Like we've got
We do.
yeah, if you want to show how that works, right? For Valoris Capital Partners, we're obviously a partner with you guys, right? So we've set up a landing page. So yeah, give us a little rundown on how that works.
Let me go ahead and pull that up right now for you, Jeff, and I can certainly help speak to that here today.
Nice. That's awesome. Well, yeah, I mean, and while you're doing that, I think I love the opportunity, right, to
Mm,
for investors to diversify, right? And there are opportunities for people to invest with a tax a free type, not tax free, but like IRA investment account, right? And then also you can utilize your own capital, right, for other deals and so forth. So you
right.
get multiple income streams coming in, and that's what
That's
I'm
it.
about is helping people understand different ways to invest and different ways to make passive income. And I consider this as passive income. So you're passively making money, but you're
100%.
also doing it on a tax-free event, and you're building up your portfolio for what we all want to do when we retire and we want to travel and not worry about how to survive, right? How to
Well,
live.
Well, that's just it, Jeff. I mean, at the end of the day, this is a great way that I've seen people create generational wealth in a tax-free system, especially with Roth IRAs. I mean, that's something I want to speak to too is a Roth IRA. At the end of the day, I mean, I haven't heard of income taxes going down on a year-over-year basis. I'd welcome somebody to go ahead and point that out if they have. But at the end of the day, if you can pay your taxes on that seed investment, let's use $50,000 for an example. I pay that tax on the $50,000. I put it in a Roth account, and let's say I let that thing ride, Jeff. Let's say I let it ride over a few different deals over the course of 20 years. Well, I look up and that 50,000 is now 300,000, and say I'm 59 and a half. I want to pull that $300,000 out. Not only is my investment still cash flowing, but I'm able to take that out and when I take it out, it's not a taxable event.
There you
I
go.
could
Yeah.
I could go ahead and spend what I want when I want with that $300,000. I don't have to go ahead and also consider what how much of the pie is the federal government going to get when I go ahead and take that out. But here's going to be that landing page that you were speaking to, Jeff. It's going to be a seamless way that people can go ahead, open up that IRA account, and also endorse those subscription agreements in one go. And it's also going to speak to alternative investments and a little bit more about Valoris Capital Partners as well. Just making sure that we can be a reliable point of contact. And as always, Jeff, I mean, if any investor ever has any questions, I would recommend they reach out to me. I'm more than willing to go ahead, meet with them on a Microsoft Teams basis, walk through exactly what IRA account is going to best fit them and what their goal is at the end of the day to make sure that we can get them into a real estate opportunity in a frictionless environment and really have that high level of discussion because for many people it's their first time, Jeff, going ahead and deploying
Yeah.
capital with that self-directed IRA. And a lot of people don't know the questions to ask. They don't know where to start. And that's really where we're here to help.
Nice. Awesome. Well, I'm very excited to have this. And just so everyone knows too, we're going to be posting this on our website. So we'll have a link to this from our from valoriscapitalpartners.com. I also have a blog I wrote about why using this or how multiple job hoppers, right, have an opportunity to really consolidate and diversify into other asset classes with their 401ks. But Paul, I mean, this has been an inspiring conversation. I think we talked about it being like a 20-minute conversation. Here we go, are going on almost 40 minutes or so. I want to wrap it up here by saying I really appreciate you coming on and having this conversation with us. Your knowledge is amazing, and yeah, where can people find you, and where's the best way to connect with you?
Yeah, so people can find me here at my personal cell phone number. So call or text. Would love to absolutely have a conversation. My email's there as well. And then I also have a calendar link as well. I'm sure if you had reached out to Jeff, he'd be kind enough to place you in touch with me and onto my calendar.
Of
And
course.
yeah, would absolutely love the opportunity to speak to the tax advantages, to speak to the different types of accounts. And there's so many different areas you can pull money from. I mean, former 401ks are the most popular, but 457Bs for those government employees, 403Bs for those in the public school systems or non-for-profits. Qualified annuities can even be rolled over into a traditional IRA. So many different buckets that you can pull upon at the end of the day to go ahead and make that investment journey into real estate.
Beautiful, beautiful. Well, thank you so much for jumping on here with us today and having this conversation. We really appreciate it. So, with that being said, folks, thank you for joining and listening. And if you have any questions, reach out to myself or Paul, and we'll get you guys set up with an account and investing into our private credit fund. So we appreciate it. And with that, guys, we'll see you next time.